Hello Central Kentucky. This is the Century 21 National Residential Real Estate Market Watch for January 2023, brought to you by Century 21 Simpson & Associates. Where is the national residential market today? We're going to take a look at the key housing market metrics and walk through relevant narratives around the housing market right now. November marks the fifth consecutive month of 3.1 to 3.3 months supply of inventory, or MSI. Although to many sellers and agents, the market feels like it's cooling off, the market is not yet balanced and continues to favor sellers. To keep this in historical context, before December 2019, months' supply of inventory had only dropped below 3.5 twice since monthly tracking began in 1999. As a reminder, 6 months of inventory represents a balanced market, favoring neither buyer nor seller. With 3.3 months supply of inventory, the market continues to favor sellers, albeit with a little more breathing room for buyers today than we've seen in a while. The actual number of unsold homes on the market dipped down from the previous month, but is up from the previous year. As mentioned in previous months, it's worth highlighting that high interest rates aren't just keeping buyers on the sidelines, they're also impacting sellers' desire to list. When they have an ultra-low rate locked in, it's often a large psychological and financial hurdle to give that up for a rate that's twice as high. However, there will always be reasons that sellers need to sell, even with high interest rates. Even with what might feel like high interest rates, there are buyers who are motivated to purchase. In order to provide enough homes, the gap in inventory created by the dampened pace of new home builds must make progress towards closing to promote the long-term health of the housing market. As expected, existing home sales declined again in November. It's important to note that the Fed wanted to cool the real estate market with increased interest rates. It has succeeded. Nadia Evangelo, National Association of Realtors senior economist and director of forecasting, put this in context. With mortgage rates double those of a year ago, home sales activity has declined significantly compared to the previous year. However, this year's activity is only 4% lower than the historical average. About 4.9 million homes are usually sold during January and November of each year. This year, 4.7 million homes were sold. In essence, the residential real estate market was frozen in November, resembling the sales activity seen during the COVID-19 economic lockdowns in 2020, said National Association of Realtors chief economist Lawrence Yun. The principal factor was the rapid increase in mortgage rates, which hurt housing affordability and reduced incentives for homeowners to list their homes. Plus, available housing inventory remains near historic lows. Home prices are still up from last year. Yet, if prices continue to fall at this pace, year-over-year declines will start showing up in February. The year-over-year increase has fallen below the historic norm of 4% annual growth. This is in line with expectations that appreciation will begin to slow but still remain positive for most markets. A continued imbalance of supply and demand bolsters prices. As fewer higher-priced homes sell, the median price could skew downward, even if individual homes are not losing value. The $1 million plus segment of sales has the largest decline in sales compared to a year ago. These sales are down 41.2%. The $250,000 to $500,000 range is down 33.6% and $500,000 to $750,000 down 32%. These two price brackets account for 60% of all sales. Pricing homes well from the beginning is important, especially since the multiple offer frenzy of the past few years has come to an end. Since peaking at 7.08% the week of November 10, rates have fallen back to the 6.3 to 6.5% range. Unless inflation surprises with an upswing, mortgage rates will move closer to 6% at the beginning of the next year, bringing more buyers back to the market, says Nadia Evangelo, senior economist and director of forecasting for the National Association of Realtors. As a reminder, rates had never fallen below 5% before 2009. In the 2000s, the average was 6.29%. In the 1990s, it was 8.12%, and the 1980s saw an average 30-year fixed rate of 12.71%. So, while the pace of increase this year has undoubtedly felt jolting and left buyers and sellers feeling the mismatch between expectations set over the past decade, with an average rate of only 4.09%, and the current rate, it's a far cry from the all-time high. Days on market continue to tick up from the all-time low of 14 in July 2022 to 24 days in November as the market returns to more normal conditions. The level of competition continues to moderate for those homes. The average number of offers per listing was 2.3, again representing a return to normal conditions. There's a clear trend towards homes taking longer to sell that should not be minimized. However, keeping that in context is critical. The market has shown it's returning to normal. It has not shown signs that it's icing over. Headlines: The Fed has succeeded in cooling the real estate market through increased interest rates. Sales are down, and annual home price appreciation has finally fallen below historic norms. Yet there continues to be a shortage of inventory, which poses an interesting question. If rates were to drop notably, would we see the market heat back up, like when COVID lockdowns were lifted? If we look at the last two times that sales were nearest that of November 2022, at 4.09 million, inventory paints an interesting picture of what's happening in the background. In May of 2020, when existing home sales were at 4.01 million, months' supply of inventory was at 4.6, with 1.5 million homes on the market. In November 2010, inventory levels were more than double that, with 9.4 months' supply and 3.2 million homes on the market. In 2010, we were still recovering from the Great Recession. Mortgage rates were around 4%. People didn't want or weren't able to buy homes. For many, that was the result of financially distressed times that many households experienced during the recession. Today, people want to and are able to buy homes. However, the rates have changed what they can afford, and they might not like that. Sellers might be holding on to a home they don't truly want because they can't justify the difference in their monthly payment from higher rates. Many large home builders have recently halted land acquisitions for new builds. They're looking to the economy and feeling the risk of a recession ahead. During the Great Recession, many of the nation's largest home builders folded. The remaining ones have not kept pace with demand. The result has been tight inventory conditions. If rates fall again and buyers rush out to purchase while their dollar buys them more house, it's quite possible the market will quickly turn red hot again. Buyers that can afford to buy at increased mortgage rates may want to seriously consider this when thinking about their timing. Sellers in a similar position may want to evaluate their wants and needs in a broader sense than simply mortgage rates right now. In other words, what position would they be in if the market reignites? Would it be better for them to take on a higher payment now with higher interest rates? Or would it be better to be in the same position of many sellers over the past 2 to 3 years of being ready and willing to sell but not able to find a suitable next home? We're not saying rates are ready to drop. All indications right now point to more elevated rates staying around for a while. However, we can't account for all variables. There are no crystal balls. No one expected the impact of COVID on the housing market. Engaging in what-if scenarios can help buyers, sellers, and agents explore future possibilities and get to the heart of their wants and needs. Your actions as a buyer or a seller. As a buyer, you might have noticed that interest rates have jumped up considerably. Yet, interest rates are only one factor in what your final monthly mortgage will be. The price of the house matters, too. Today, buyers are able to purchase more than 3/4 of the homes on the market for list price or less, unlike recent years when buyers bid up the list price dramatically. Second, we don't exactly know what will happen in the future with inventory or interest rates. You can refinance to a lower rate later. If we find the right house and the price and mortgage rate work out, wouldn't it be great to make the move instead of waiting on an uncertain future? As a seller, timing the market is nearly impossible. The best we can do is read and react to the data available, and it's sending a clear message. If you're ready to sell, it's best to act now instead of waiting on the market to move in your favor. Especially if you'd like to buy as well, it's better to get everything in alignment and get the process started. Sellers are starting to lose that incredible upper hand they'd had over the past few years as the market moves toward being more balanced. Inventory, interest rates, and prices are impacting buyers. Have your realtor run the numbers based on the market and see if that achieves your financial goals. If it does, consider acting now. Whatever your real estate needs, it is important to select the right real estate agency and real estate agent. 26% of sellers say that trust is the most important thing when selecting an agent. 12% say that market knowledge is one of their top decision points. For buyers, 98% say that honesty and integrity are very important, and 76% say local market knowledge is very important. At Century 21 Simpson & Associates, we have helped people, like you, with the buying and selling of homes in central Kentucky and adjacent areas for over 30 years. We love being part of our community, and we hope to continue to serve all of the area's real estate needs for years to come. We are proud of the designation of Realtor because it signifies honesty, ethical dealings, and being fair to your customers. In fact, our agents have helped us win the coveted Century 21 Quality Service Award every year since 1993 based on client feedback. And because of our commitment to outstanding service, we've been the #1 real estate agency in Franklin County, Kentucky in closed unit and closed volume in 2019, 2020, 2021, and 2022. With offices in Frankfort and Lexington, Kentucky, our agents and staff members are professionals from diverse backgrounds and are dedicated to providing the highest quality service to our clients. If you're considering buying or selling property, let us put our extensive experience and knowledge about our local real estate markets to work for you. Have questions? We are here to help. Contact our Frankfort or Lexington offices or visit us at century21simpson.com to see current listings or learn more about us. If you like this Market Watch, we invite you to subscribe to our YouTube channel, and if you'd like to be notified when the February 2023 Market Watch is available, be sure to click the bell icon.